Alrighty, equity investment, our next major topic of the CFA Level 1 program curriculum. We're almost done. 1,000 more pages go. We could do this. Okay, equity investment. Our study session is broken down to study session 14 and 15. Equity section part 1 and part 2 respectively. The candidate should be able to describe characteristics of equity investment, security markets, and indexes. The candidate should be also able to analyze industries, companies, and equity securities, and to describe and demonstrate the use of basic equity valuation models. Global equities are an important asset class for meeting longer-term growth and diversification objectives. Global equities also represent a substantial share of capital market that have been expanding in breadth and depth as developing economies come to market to equity capital, as developed and emerging economies continue to open their markets into investments. Their activities expect to significantly change in the composition of world equity markets. Study session 14, equity investment part 1. The study session provides a structural overview of financial markets and their operating characteristics. Overview markets include equities, fixed incomes, derivatives, and alternative investments, various asset types, market participants, and how asset trades within these markets and ecosystems are described. Coverage of these core asset classes continue in subsequent Level 1 study sessions, laying the foundation for further studies in Level 2 and 3. This study session and then turns to the calculation, construction, and use of security market indexes, a discussion of market efficiency and the degree to which market prices may reflect the available information. Concludes this section. Reading assignments. Reading 44 about market organization and structure. Reading 45 about security market index. Reading 46 about market efficiency. Reading 44, market organization and structure. Learning outcomes. The candidate should be able to explain the main function of the financial system, describe classifications of assets and markets, describe major types of securities, currencies, contracts, commodities, real estate that trade in organized markets, including their distinguishing characteristics and major subtypes. Describe types of financial intermediaries and services that they provide. Compare positions an investor can take in an asset. Calculate and interpret the leverage ratio, the rate of return to margin transactions, and the security price at which the investor would receive a margin call. Compare market orders with limits orders. Define primary and secondary markets and explain how secondary markets support primary markets. Describe how securities, contracts, and currencies are traded in quota-driven or order-driven and broker markets. Describe characteristics of a well-functioning financial system. Describe objectives of market regulations. Introduction. Financial analysis gathered and processes information to make investment decisions, including those related to buying and selling assets. Generally, the decision involves trading securities, currencies, contracts, commodities, and other real assets, such as real estate. Consider several examples. Fixed income analysis. Evaluate issuer credit worthiness and macroeconomic prospects to determine which bonds and notes to buy or sell to preserve capital while obtaining a fair rate of return. Stock analysis. Study corporate value to determine which stocks to buy or sell to maximize the value of your stock portfolios. Corporate treasurers analyze exchange rates, interest rates, and credit conditions to determine which currencies to trade and which notes to buy or sell to have funds available in needed currency. Risk managers work for producers or users of commodities to calculate how many commodity future contracts to buy or sell to manage inventory risk. Financial analysis must understand the characteristics of the market and ways their decision will be executed. This reading, by examining these markets from the analyst perspective, provides that understanding. This reading is organized as follows. Section 2 examines the function of the financial system. Section 3 introduces assets that investors, information-motivated traders, and risk managers use to advance their financial objectives, and present ways practitioners classify these assets into markets. These assets include such financial instruments as securities, currencies, and some contracts, certain commodities, and real estate. Financial analysts must know the distinctive characteristics of these trading assets. Section 4 is an overview of financial intermediaries. Section 5 discusses the positions that can be obtained while trading assets. You will learn about the benefits and risks of long and short positions, how these positions can be financed, and how the financing affects their risk. Section 6 discusses the market participants' orders, trades, and how market processes these orders. This process must be understood to achieve trading objectives while controlling transactional costs. Section 7 focuses on describing primary markets. Section 8 describes structures of secondary markets and securities. Section 9 and 10 close the reading with discussions of the characteristics of a well-funded, functioning financial system. Okay. Section 2, the function of the financial system. Financial system includes markets and various financial intermediaries to help transfer financial assets, real assets, financial risk in various forms from one entity to another, from one place to another, and from one point to another. These transfers take place or whenever someone exchanges one asset to financial contracts for another. The asset and contracts that people trade, including notes, bonds, stock, exchange traded funds, currencies, for contracts, future contracts, option contracts, swap contracts, and certain commodities. When their buyer and seller voluntarily arrange their trades, and usually the case, the buyer and the seller both expect to be better off. People use the financial system for 6 main purposes: to save money, to borrow money, to raise equity, to manage risk, to exchange assets, to achieve the purposes of the financial system, to discover the discovery of rates of return, and the allocation of capital for the best use. These functions are extremely important to economic welfare. In a well-functioning financial system, transactional costs are low. Analysts can value savings and investments, and scarce capital resources are used well. Section 2.1 and 2.3 expands on these 3 functions. The 6 subsections of Section 2.1 covers the 6 main points, purposes of which people use the financial system, and how financial systems facilitates the achievement of these purposes. Section 2.2 and 2.3 discusses determining rates of return and capital allocation efficiency respectively, helping people achieve their purposes in using the financial system. People often arrange transactions to achieve more than one purpose when using the financial system. For example, an investor who buys the stock of an oil producer may do so to move her wealth from the present to the future, to hedge the risk that she will have to pay more energy in the future, and to exploit insightful research that she conducted that suggests that a company's stock is undervalued in the marketplace. If the investment proves to be successful, she will have saved money for the future, managed her energy risk exposure, and obtained a return on her research. The separate discussion of each of the 6 main uses of the financial system by people will help you better identify the reasons why people trade. Your ability to identify the various uses of financial intermediaries that are mentioned in these discussions are explained further in Section 4. Savings. People often have money that they choose not to spend now and that they want to be available in the future. For example, workers to save for their retirement need to move some of their current earnings into the future. When they're retired, they will use the savings to replace their wages that they will no longer be earning. Similarly, companies save money from their sales revenues so that they can pay vendors who when their bills come due, repay debts, or acquire assets in the future. Borrowing. People, companies, and governments often want to spend money now and that they do not have. They can obtain money to fund projects that you wish to undertake now by borrowing it. Companies can also obtain funds by selling ownership or equity interest. Banks and other investors provide these requiring funds with money because they expect to be repaid with interest, or because they expect to be compensated with further disbursements, such as dividends or capital gains, as ownership interest appreciates in value. financial system facilitates borrowing. Lenders aggregate from savers to funds that borrowers require. Borrowers must convince lenders that they can repay their loans, and that in the event they cannot, lenders can recover most of the funds lent. Credit bureaus, credit rating agencies, and government promotes borrowings. Credit bureaus and credit rating agencies do so by collecting and disseminating information that lenders need to analyze credit prospects, and governments do so by establishing bankruptcy codes and courts that define and enforce the rights of borrowers and lenders. When the transaction costs of loans are low, borrowers can borrow more to fund current expenditures when credible promises to returns of the money in the future. Raising equity capital. Companies often raise money to project for projection projects by selling or issuing ownership or interest. Although these equity instruments legally represent ownership in companies rather than loans to the companies selling equity, to raise capital is simply another mechanism for moving money from the future to the present. When shareholders or partners contribute capital to a company, the company obtains money in the present to exchange for equity investment that will be entitled to distribution in the future, although the repayment of this money is not scheduled as it would be for loans. Equity in instruments also represent potential claims on money in the future. The financial system facilitates raising equity capital. Investment banks help companies issue equities. Analysts value the securities that companies sell, and regulatory reporting requirements and accounting standards attempt to ensure the production of meaningful financial disclosures. The financial system helps promote capital information by producing the financial information needed to determine fair prices for equity. Liquid markets help companies raise capital. In this market, shareholders can easily divest their equities as desired. When investors can easily value the trade equities, they are more willing to fund reasonable projects that companies wish to undertake. Managing risk. People, companies, and governments face financial risks that concern them. These risks include default risk and risk charged an interest rate, exchange rate, raw material prices, and sale prices, among many of other risks. These risks are often managed by trading contracts that serves as hedge for the risk. Exchanging assets for immediate delivery. People and companies often trade one asset for another that their rate may more highly or equivalently that is more useful to them. That they may trade one currency for another currency, or money for a needed commodity or right. Following the same example of illustrated the trades. Information motivated trading trades to profit from information that they believe allows them to predict future prices. Like all other traders, they hope to buy at low prices and sell at higher prices. Unlike pure investors, however, they expect to earn a return on their information in addition to the normal returns expected by bearing risk through time. Two categories of traders are not mutually exclusive. Investors also are often information-motivated traders. Many investors who want to move wealth from forward through time collected and analyzing the information to select securities that will allow them to obtain conditional returns that are greater than the unconditional returns expected for securities in the asset classes. If they have rational reasons to expect that their efforts will indeed produce superior returns, they are information-motivated traders. If they consistently fail to produce such returns, their efforts will be futile, and they will be better off simply buying and holding well-diversified portfolios. Summary: people use financial systems to many purposes, and many, most important of which are saving, borrowing, raising equity capital, managing risk, exchanging assets in spot market, and information motivated trading. The financial system best facilitates these uses when people can trade instruments that interest them in liquid markets. When institutions provide financial services at low cost, when information about assets and about credit risks is readily available, and when regulations help ensure that everyone faithfully honors their contracts determining rates of return. Saving, borrowing, and selling equities are all means of moving money through time. Saving money saving more money from the present to the future, whereas borrowing and equity issuers move money from the future to the present because time machines do not exist. Money can travel forward in time only if an equal amount of money is traveling in another direction. This equity always occurs because borrowing an equity seller creates the security in which savers invest. For example, the bond sold by a company that needs to move money from the future to the present is the same bond bought by the saver who needs to move money from the present to the future. The aggregate amount of money that savers will move from the present to the future is related to the expected rate of return on the investment. If the expected return is high, then they will forego current consumptions to move more money to the future. Similarly, to aggregate amount of money that borrowers and equity sellers will move from the future to the present depends on the cost of borrowing funds or of going up ownership. These costs can be expressed as a rate of return that borrowers and equity sellers are expected to deliver in exchange for obtaining current funds. It is the same rate that savers expect to receive when delivering current funds. If this rate is low, borrowers and equity sellers will want to move more money to the present from the future. In other words, they will want to raise more funds, but because the total money saved must equal the total money borrowed and received in exchange for equity. The expected rate of return depends on the aggregate supply of funds through savings and the aggregate demand for funds. If the rates are too high, savers will want to move more money from the future than borrowers and equity issuers will want to move to the past. Economists call this rate the equilibrium interest rate. It is the price for moving money through time. Determining the rate. This rate is one of the most important functions of the financial system. The equilibrium interest rate is only one interest rate that would exist if all securities were equally risky, had equal terms, and when equally liquid. In fact, the required rate of return for securities vary by their risk characteristics, terms, and liquidity. For a given issuer, investors generally require higher rates of return for equity than for debt, for long-term securities than for short-term securities, and for liquid securities than for liquid ones. Financial analysts recognize that all required rates of returns depend on a common equilibrium interest plus the adjusted rate of the risk capital allocation efficiency. Primary capital markets. Primary markets are markets in which the companies and governments raise capital or funds. Companies may raise funds by borrowing money or by issuing equity. Governments may raise funds by borrowing money. Economies are said to be allocationally efficient when the financial system allocates capital to the uses that are most productive. Although companies may be interested in getting funding to many potential projects, not all projects are worth funding. One of the most important functions of the financial system is to ensure that only the best projects obtain secure capital funds. The funds available from savers should be allocated to the most productive uses. In market-based economy, savers determine directly or indirectly which projects obtain capital. Savers determine capital allocation directly by choosing which securities they will invest in. Savers determine capital allocation indirectly by giving funds to financial intermediaries that then invest in the funds. Because investors fear the loss of their money, they will lend at lower interest rates than borrowing with the best credit prospects or the best collateral. They will lend at higher rates to other borrowers with less secure prospects. Similarly, they will buy only those equities that they believe have the best prospects relative to their price and risk. Part 3, assets and assets and contracts. People, companies, and governments use many different assets to construct and contracts to further their financial goals and manage their risks. The most common assets includes financial assets, currencies, certain commodities, and real estate. The most common contracts are options, futures, swaps, forwards, swaps, and insurance contracts. People's companies and governments use these assets and contracts to raise funds, to invest, to profit from information motivated trading and to hedge risk, and or to transfer money from one form to another. Classifications of assets and markets. Practitioners often classify assets as and the markets in which they trade by various common characteristics to facilitate communication with their clients, with each other, and with regulators. The most actively traded assets are securities, currencies, contracts, and commodities. In addition, real estates are traded. Securities generally includes debt instruments, equities, and shares and pooled investment vehicles. Currencies are money issued by national monetary authorities. Contracts are agreements to exchange securities. Currencies, commodities are other contracts in the futures. Commodities includes precious metals, energy products, industrial materials or industrial metals, and agricultural products. Real estates are tangible properties such as real estate. A real asset applies airplanes, machinery, securities, currencies, and contracts are classified as financial assets, whereas commodities and real estate are classified as physical assets. Securities are further classified as debt or equity. Debt instruments are promises to repay borrowed money. Equities represents ownership in companies. Pooled investment vehicles shares represent ownership of an undivided interest in an investment portfolio. The portfolio may include securities, currencies, contracts, commodities, and real estate. Pooled investment vehicles such as exchange-traded funds, which exclusively own shares in other companies, generally are also considered equities. Securities are also classified by whether they are public or private securities. Public securities are those registered to trade in public markets, such as one traded or through dealers. In most jurisdictions, issuers must meet stringent minimum regulatory standards, including reporting and corporate governance standards to issue publicly traded securities. Private securities are all other securities, often when respectively qualified investors can purchase private equities and private debt. Investment investors may purchase them directly from the issuer or indirectly through an investment vehicle specified formed to help such as securities. Contracts are derivative contracts. Contracts are derivative contracts if their value depend on the prices of other underlying assets. Derivative contracts may be classified as physical or financial depending on whether the underlying instruments are physical products or financial securities. Equity derivatives are contracts whose value depend on equities or indexes of equities. Fixed income derivatives and contracts whose value depend on debt securities or indexes of debt securities. Practitioners classify markets by whether the market trading instruments for immediate delivery or future delivery. Markets trading contracts that cause for delivery in the future are forwards or future markets. These trades are immediately delivered are called spot markets to distinguish them from the forward markets and trading contracts. When issuers sell securities to investors, practitioners says that they trade in the primary market. When investors sell securities to others, the trade is in the secondary market. The primary market funds flows to the issuer of the security from the purchaser. In the secondary market, funds are between traders. Practitioners classify financial markets among five financial markets as money markets or capital markets. Money markets trade debt instruments maturing in 1 year or less. The most common common such instrument is the repurchase agreement, negotiable certificate of deposits, government bills, and commercial papers and contracts. Capital markets trade instruments of longer durations, such as bonds and equities, whose value depends on the credit worthiness of the issuer and payments of the interest or dividend that will be made in the future and be uncertain. Corporations generally finance their operations in the capital markets, but some also finance a proportion of their operations by using short-term securities, such as commercial papers. Finally, practitioners distinguish between traditional investment markets and alternative investment markets. Traditional investment includes all publicly traded debts and equities, and shares and pooled investment vehicles that held publicly traded debts and or equities. Alternative investments include hedge funds, private equities, commodities, real estate securities, and real estate properties, scrutinized debts, operating leases, machinery, collectibles, and precious gems. Because these investments are often hard to trade and hard to value, they may sometimes trade as substantial deviations from their intrinsic value. The discounts compensate investors for the research that they must do to value these assets and for their inability to easily sell the assets if they need to liquidate a portion of their portfolio. The reminder of this section describes the most common assets and contracts that people, companies, and governments entail. I'm drinking black tea today. 3.2, securities. People, companies, and governments sell securities to raise money. Securities includes bonds, notes, commercial papers, mortgages, common stock, preferred stock, warrants, mutual fund shares, unit trust, and depository receipts. These can be classified broadly as fixed income instruments, equities, and shared and pooled investment vehicles. Note that an legal definition of a security varies by country and may or may not coincide with the usage here. Securities are also sold to the public, or that can be resold to the public and called issues. Companies and governments are the most common issuers. Fixed income instruments contractually include predetermined payment schedules that usually include interest and principal payments. Fixed income instruments generally are promises to repay borrowed money, but may include other instruments with payment schedules. Payment schedules such as settlements of legal cases or prices of lotteries. The payment amounts may be pre-specified or may vary according to the fixed formula that depends on the future value of an interest rate or a commodity price. Bonds, notes, bills, certificates of deposit, commercial papers, repurchase agreements, loans agreements, and mortgages are examples of promises to repay money. In the future, people, companies, and governments create fixed income instruments when they borrow money. Equities represents ownership rights to a company. These include common and preferred shares. Common shareholders own residual rights to the assets of the company. They have the right to receive any dividends declared by the board of directors, and in the event of liquidation, any assets remaining after all other claims are paid, acting through the board of directors. That they elect. Common shareholders usually can select the managers who run the corporations. Warrants are securities issued by corporations that allows the warrant holder to buy a security issued by the corporation if they are desired, usually at any time before the warrants expire, or if not, upon expiration. The security that warrant holders can buy usually is the issuer's common stock, in which case the warrants are considered equities because the warrants holders can obtain equity in a company by exercising their warrants. The warrant exercise price is the price that the warrant holder must pay to buy the securities. Pooled investment vehicles are mutual funds, trust depositories, and hedge funds that issue securities that represent a shared ownership in an asset, and the entities holds the securities creates a mutual funds, trust depositories, and hedge funds are respectively called shares, units, depository receipts, and limited partnership interests. Bar practitioners often use these terms interchangeably. People invest in pooled investment vehicles to benefit from the investment management services of their managers and from diversification opportunities that are not readily available to them on the individual basis. The primary distinguishing characteristic of hedge funds and their management compensation scheme is the management compensation scheme. Almost all funds pay their managers with annual fees that is proportional to their assets, and with an additional performance fees that depends on the wealth of the funds generated for the shareholders. A secondary distinguishing characteristic of many hedge funds is the use of leverage to increase risk exposure and hopefully increase returns. Currencies are monies issued by national monetary authorities. Approximately 175 currencies are currently in use throughout the world. Some of these currencies are regarded as reserve currencies. Reserve currencies are currencies that national central banks and other monetary authorities hold in significant quantities. The primary reserve currency is the U.S. dollar and the euro. Secondary reserve currencies includes the British pound, Japanese yen, and Swiss franc. Contracts. A contract is an agreement among traders to do something in the future. Contracts include forwards, futures, swaps, options, and insurance. Contracts. The value of most contracts depend on the value of the underlying assets. The underlying asset may be a commodity, a security, an index representing the value of other instruments, a currency paired or basket, or other contracts. Contracts provide for some physical or cash settlement in the future. In a physically settled contract, settlement occurs when a party of the contract physically exchanges some items such as tomatoes, pork bellies, or gold bars. Physical Settlements are included. Also includes the delivery of such financial instruments as bonds, equities, or futures contracts, even though the delivery is electronic. In contrast, cash settled contracts settled through cash payments. The amount of payments depends on the formulas specified in the contract. Financial analysts classify contracts by whether they are physical or financial based on the nature of the underlying asset of the physical product. The contract is physical, otherwise the contract is a financial. Examples of assets classified as physical include the contracts for the delivery of petroleum, lumber, and gold. Examples of assets classified as financial includes option contracts and contracts on interest rates, stock indexes and currencies, and credit default swaps. Contracts that call for immediate delivery are called spot contracts, and they trade in spot markets. Immediate delivery, generally in 3 days or less, but depends on each market. All other contracts involve what practitioners call futurities. They derive their value from the events that they will take place in the future. A forward contract is an agreement to trade an underlying asset in the future at a price agreed upon today. For example, a contract to sell wheat after the harvest is the forward contract. People often use forward contracts to reduce risk. Before planting wheat, farmers like to know the price at which they will sell their crops. Similarly, before committing to sell flour to bakers in the future, millers like to know their prices that they will pay for wheat. And farmers and the millers both reduce their operating risk by agreeing to trade wheat forwards. Futures contracts is a standardized forward contract for which a clearinghouse guarantees the performance of all traders. The buyer of the future contracts is the side that will take physical delivery or its cash equivalent. The seller of the future contract is the side that is liable for the delivery of its contract of its cash equivalent. Or clearinghouse as an organization that ensures that no trader is harmed if another trader fails to honor its contracts. In effect, the Clearinghouse Act as the buyer for every seller, and as the seller for every buyer. Buyers and sellers therefore can trade futures without worrying whether the counterparties are credit worthy. Because futures contracts are standardized, a buyer can eliminate his obligations or to buy by selling his contracts to anyone. A seller similarly can eliminate her obligation by delivery by buying a contract from anyone. Futures contracts have vastly improved the efficiency of futures contract markets. Traders can trade standardized future contracts with anyone without worrying about counterparty risk. Other contracts, commodities. Commodities include precious metals, energy products, industrial metals, agricultural products, and carbon credits. Spot commodity markets trades commodities for immediate delivery, whereas the forward and future markets trade commodities for future delivery. Managers seeking positions in commodities can acquire them directly by trading in the spot market or indirectly by trading forwards and futures contracts. Some information motivated traders and investment managers, however, trade in the spot commodity market, especially when they can easily contract for low-cost storage commodities, for which delivery and storage costs are lowest, and non-perishable products, for which the ratio of value to weight is high and a variation in quality is low. These generally include precious metals and industrial diamonds, such high-value industrial metals as copper, aluminum, and mercury, and carbon credits. 3.6, real estate. Real assets includes tangible properties as real estate, airplanes, machineries, and lumber stands. The assets normally are held by operating companies such as real estate developers, airplane leasing companies, manufacturers, and loggers. Many industry institutions, investment managers, however, have been adding real estate to their portfolios as direct investments. And indirect investments in real estate are attractive to them because of the income and tax benefits that they often generate, and because changes in their values may have a low correlation with other investments in their management holds. Real estate is a unique unique properties in the sense that no two assets are alike. An example of unique property in real estate parcel. No two parcels are the same because if nothing else, they are located in different places. Real estate generally differs in their contracts, remaining useful lives, locations, and suitability for various purposes. These differences are very important for the people who use them. So the markets for a given real estate for real asset may be very limited. Thus, real estate tends to trade in very liquid markets. The heterogeneity of real estate, their liquidity, and the substantial cost of managing them are all factors that complicate the valuation of real estate and generally make them unsuitable for most investment portfolios. Financial intermediaries. Financial intermediaries help entities achieve their financial goals, and intermediaries include commercials, mortgages, and investment banks, credit unions, credit card companies, and various other finance corporations, bankers and exchangers, dealers and arbitrageurs, clearing houses and depositories, mutual funds and hedge funds, the insurance companies. The service and products and financial intermediaries allow their clients to solve the financial problems that they face more efficiently than they could do so by themselves. Financial intermediaries are essential to well-functioning financial systems. Financial intermediaries are called intermediaries because the services and products that they provide help connect buyers to sellers in various ways. Whether the connections are easy to identify to involve complex financial structures, financial intermediaries stand between one or more buyers and one or more sellers to help them transfer capital and risk between them. Financial intermediaries allows buyers and sellers to benefit from the trade, often without any knowledge of the other. Brokers, exchanges, and alternative trading systems. Brokers are agents who fill orders for their clients. They do not trade with other clients. Instead, they research for traders who are willing to take for the other side of the client's orders. Individual brokers may work for large brokerage firms, a brokerage arm, or of banks or exchanges. Some brokers match clients to client personally. Others use a specialized computer system to identify potential traders. Block brokers provide brokerage services, and large orders are hard to fill because finding a counterparty willing to do a large trade is often quite difficult. A buy order generally will trade at a premium to the current market prices, and a large sell order generally will trade at a discount to the current market prices. These make large trades reluctant, however, to expose the orders to the public before their trades are arranged because they do not want to move the markets. Block brokers therefore carefully manage their exposures of the orders entrusted to them, which makes filling them difficult. Investment brokers provide advice to most corporate clients and make them arrange transactions such as initial seasoned securities offerings. Their corporate finance division helps corporate finance their business by issuing securities such as common and preferred stocks, notes, and bonds under the function of corporate finance divisions to help companies identify and acquire their companies. Exchanges provide places where traders can meet and arrange their trades. Historically, brokers and dealers meet on exchange floor to negotiate trades. Increasingly, exchanges arrange and traders and brokers are done. Dealers to submit to them. Such exchanges essentially act as brokers. The distinction between exchanges and brokers have become quite blurred. Exchanges and brokers that use electronic orders or order matching systems and to arrange trades among their clients are functionally indistinguishable in that respect. Examples of exchanges include the NYSE or Euronext or Euronext. These examples. Alternative trading system, or ATS, also known as electronic communication networks, or ECNs, or multilateral trading facilities, or MTFs, are trading venues that function like exchanges but do not exercise regulatory authority over the subscribers except with respect to the conduct and trading in the trading systems. Such ATSs operate electronic trading systems that are otherwise indistinguishable from the trading systems operated by exchanges. Other operates in innovative trading systems that suggest trades to their customers based on information that the customers share with them, or that they obtain through research into the customers' performance. Many ATS, also known as dark pools, because they do not display the orders that the clients send to them. Large investment managers especially like these systems because market prices are often moved to their advantage when other traders know about it. Their large order ATSs may be owned and operated by broker-dealers, exchange banks, and companies organized solely for the purpose, many of which are owned by the consortia of brokers, dealers, and banks. Examples of ATS includes these examples. Dealers fill their clients' orders with tradings by trading with them with their clients want to sell securities or contracts. Dealers buy the instruments for their own accounts, and the clients if the clients wants to buy securities, dealers sell securities that they own or have borrowed. After completing the transaction, dealers hope to reverse the transactions by trading with another client on the other side of the market. When they are successful, they effectively connect a buyer to arrive at one point in time, which with a seller who arrived at another point in time. The service that dealers provide is liquid. Liquidity is the ability to buy or sell with low transactions costs when you want to trade. By allowing the clients to trade when they want to trade, dealers provide liquidity to them. In over-the-counter markets, dealers offer liquidity when their clients ask them to trade with them. In exchange, the market dealers offer liquidity to anyone who is willing to trade at the price that the dealer offers. At the exchange, dealers profit when they can buy at prices that are on average lower than the prices they are selling. Securitizers, banks and investment companies create new financial products when they buy and repackage securities or other assets. For example, mortgage banks commonly orient hundreds of thousands of residential mortgages by lending money to homeowners. They then place the mortgage in a pool and sell the shares to a pool investor as mortgages pass through securities, which are also known as mortgage-backed securities. All payments of principals and interest are passed through to the investor each month. After deducting the cost of servicing the mortgages, investors who purchase these pass-through securities obtain securities that are aggregate have the same net cash flows and associated risk at the pool of mortgages. In many securitizations, the financial intermediaries avoid placing the assets and liabilities on the balance sheet by setting up a special corporation and trust that buys the assets and issuers the securities. The corporations or trust is called the special purpose vehicle, or alternatively a special purpose entity. Conducting a securitization through a special purpose vehicle is advantageous to investors because their interests in the asset pool are better protected in the SPV than they would be on a balance sheet of the financial intermediary if the financial intermediary were to go bankrupt. Financial intermediaries scrutinize many assets besides mortgages. Banks scrutinize car loans, credit cards, receivables, bank loans, etc. Depository institutions and other financial corporations. Depository institutions include commercial banks, savings and loan banks, credit unions, and similar institutions that raise funds from the depositor and other investors and lends it to the borrowers. The banks give their deposits interest and transaction services such as a check writing and check cashing in exchange for using your money. Depository banks and financial corporations are similar to securitized asset pools that issues pass-through securities through deposits, and investors owns securities that ultimately are backed by an asset pool consisting of their loan portfolios. The depositors generally hold the most senior tranche, followed by the order of the other creditors. The shareholders hold the most junior tranche. In the event of bankruptcy, they are paid only if everyone is paid. Insurance companies help people and companies offset a risk that concerns them. They do this by creating insurance contracts or policies that provide payment in the event that some loss occurs. The insured buys these contracts to hedge against potential losses. Common examples of loss of contracts include auto, file, life, liability, medical, death, disaster insurance contracts. Arbitrageurs, clearance house. Summary: by facilitating transactions among buyers and sellers, financial intermediaries provide services essential for a well-functioning financial system. They facilitate transactions by the following ways: brokers, exchanges, and various alternative trading systems match buyers and sellers interested in trading the same instruments that are at the same place and time. These financial intermediaries specialize in discovering the organizing information about who wants to trade. Dealers and arbitrageurs connect buyers and sellers' interest in trading the same instruments, but who are not present at the same place and time. Dealers connect buyers to sellers who are present at the same place but are different times, whereas arbitrageurs cannot connect buyers to sellers who are present at the same time but in different places. The financial intermediaries trade from their own accounts. When providing these services, dealers buy or sell with one client and hope to do the offsetting transactions later with another client. Arbitrageurs buy from a seller in one market while simultaneously selling to a buyer in another market. Many financial intermediaries create new instruments that depends on the cash flows and associated financial risk of another instruments. The intermediaries provide these services when they scrutinize asset, manage investment funds, operate banks and their finance corporations that offer investments to investors and loans and borrowers, and operate insurance companies that pool the risk. The instruments that they create generally are more attractive to their clients than the instruments on which they are based. The new instruments also may be different to appeal to diverse clienteles. Banks, clearinghouses, and depositories provide services that ensures traders settles their trades and that the resulting positions is not stolen or pledged more than once as collateral positions. People generally solve their financial and risk management problems by taking positions in various assets or contracts. A position is an asset in the quantity of the instrument that the entity owner or owners or owns. A portfolio consists of a set of positions. People have long positions when they own assets or contracts. Examples of long positions include ownership of stock, bonds, currency, contracts, commodities, or real estate. Long positions benefit from appreciations in the prices of the assets to contracts owned. People have short positions when they have solid assets they do not own, or when they write and sell contracts. Short positions benefit from a decrease in the prices and the assets or contracts sold. Short sellers profit by selling at high prices and repurchasing at low prices. Information motivated traders sell asset and contracts short positions when they believe the prices will fall. Short sellers create short positions and contracts by selling contracts that they do not own. In a sense, they become the issuers of the contract when they create liabilities associated with the contracts. This analogy will also help you better understand risk when you study corporate finance. Corporate creates short positions in their bonds when they issue bonds in exchange for cash. Although bonds are generally considered to be securities, there are also contracts between the issuer and the bondholder. Short sellers create short positions in securities by borrowing securities from security lenders who are long holders. The short sellers then sell the borrowed securities to another trader. Short sellers closes their position by repurchasing the securities and returning them to the security lenders. If the security value is dropped, then short seller profits because the repurchase of the security at lower prices than the purchase at which they sold the security. If the security raises its value, they will lose. Short sellers who buy the close their positions are said to cover their positions. The potential gain in of long position generally is unbounded. For example, yeah, you guys should know that. Leverage positions in many markets, traders and securities can buy securities by borrowing some of the purchase's price. They usually borrow the money from their brokers. The borrowed money is called the margin loan, and they are said to be on the margin. The interest rates that the borrowers pay for the margin loan is called the call money rate. The call money rate, not the call money rate is above the government bill rate of and is negotiable. The large buyers generally obtain more favorable rates than do retail buyers. For institutional sized buyers, the call money rate is quite low because the loans are generally well secured by securities held by collateral by their lenders. In the above example, if the stock dropped more than the buyer's original 40% margin, then the trader's equity will have become negative. In this case, the investor who owes his broker more than his stock is worth. Brokers often lose money in such situations if the buyer does not repay the loan out of other funds. To prevent such losses, brokers require the margins. Buyers always have a minimum amount of equity in their positions. The minimum amount is called the maintenance margin requirement. It is usually 25% of current value of the position, but it may be higher or lower depending on the volatility of the instrument and the policies of the broker. Traders who sell securities shorts are subject to margin requirements because they have borrowed securities. Initially, the trader's equity supporting the short positions must be at least equal to the margins requirement time. The initial value of the short position. If price rises, equity will be lost at some point. The short seller will have contribute additional equity to meet the maintenance margin requirement. Otherwise, the broker will buy the security back to cover the short position to prevent further losses and thereby secure a repayment of the stock loans orders. Buyers and sellers communicate with the brokers, exchangers, and dealers to arrange their trades by issuing orders. An order specifies the instruments to trade, how much to trade, and whether to buy or sell. Most orders also have other instructions attached to them. These additional instructions may include execution instructions, validity instructions, and clearing instructions. Execution instructions indicate how to fill the order. Validity instruction indicates when the order may be filled, and clearing instructions indicate how to arrange the final settlement of the trade. Equity execution instructions. Market and limit orders convey the most common execution instruction. Market order instructs the broker or exchange to obtain the best price immediately available when filing the order. A limit order conveys almost the same instruction: obtain the best price immediately available, but in no event accept a price higher than specified limit price when buying, or accepting a price lower than the specified limit price when selling. Many people mistakenly believe that limit orders specify the price at which the orders will trade. Although limit orders will do often trade at their limit prices, remember the first instruction to obtain the best price available. If better prices are available, then the limit price brokers and exchanges should obtain these prices for their clients. So these are just making orders. Primary security markets. When issuers first sell their securities to investors, practitioners say that the trades take place in the primary markets. An issuer makes an initial public offer, IPO, sometimes called placing of security issues. When it sells the security to the public for the first time, a seasoned security is a security that an issuer has already issued. If the issuer wants to sell additional units of previously issued securities, it makes a seasoned offering. Both types of offering occurs in the primary market when issuers sell their securities to investors. Later, if investors trade their securities among themselves, they trade in secondary markets. This section discusses primary markets and their procedures. Then issuers use the offer securities to the public. Public offerings. Corporations generally contract with an investment bank to help them sell their securities to the public. The investment bank then lines up subscribers who will buy the security. Investment banks call this process book building. In London, the book builder is called the book runner. The book tries to build a book of orders to which they could sell the offering. All investment banks often support their book building by providing investment information and opinions about the issuer to the client and to the public. Before the offering, the issuer generally makes a very detailed disclosure of the business and the risk inherent to it, and the uses of which the new funds will be placed. So this is just the IPO process, primary placement, secondary security market and contracts. Trading in the successful outcomes is the bilateral search in which buyers look for sellers and sellers look for buyers. Many market structures have developed to reduce the cost of the search. Markets are liquid when the cost of finding suitable counterparties to trade are low. Trading securities and contracts takes place in a variety of market structures. The trade differs when trades can be arranged. Who arranges the trades, how they do so, and how traders learn about possible trading opportunities and executed trades. The section introduces the various market structures that are used to trade securities and contracts. We first consider trading sessions and execution mechanisms, and finally market information systems. Trading sessions. Markets are organized as call markets or continuous trading markets. In a call market, trades can be arranged only when the market is called or a particular time and place. In contrast, the continuous trading market, trades can be arranged and executed anytime the market is open. Many continuous trading markets start their trading when a call market auction. During a pre-opening period, traders submit their orders for a market call. At the opening, any possible traders are arranged, and then trading continues in the continuous trading session. Some continuous trading markets also close their trading with a call. If these markets, traders who are only interested in trading in the close call submit markets or limit on close orders. Execution mechanism. There are three main types of market structure to quote-driven markets. Is the quote-driven markets. Customers trade with dealers. In an order-driven market, and an order mechanism matching system run by the exchange. A broker or an alternative trading system uses rules to arrange traders based on the orders that the traders submit. Most exchanges and ECNs organize their driven markets. In brokered markets, brokers arrange trades based on their customers. Broker markets are common for transactions of unique instruments such as real estate properties, intellectual property, and large blocks of securities. Many trader systems use more than one type of market structure. Okay, summary. This reading introduces how the financial system operates and explains how well-functioning financial systems lead to wealthy economies. Financial analysts need to understand how the financial system works because their analysis often leads to trading decisions. The financial system consists of markets and financial intermediaries that operates in them. These institutions allow buyers to connect with sellers. They may trade directly with each other when they trade the same instruments, or they only make trades indirectly when a financial intermediary connects to a buyer to a seller through the transactions with each that appears on the intermediary's balance sheet. The buyer and seller may exchange instruments, cash flows, or risks. The following points, among others, were made in this rating. The financial system consists of mechanisms that allows strangers to contract when each other to move money through time, to hedge risks, and to exchange assets that they value less for those that they value more. Investors move money from the present to the future. When they save, they expect to a normal rate of return for bearing risk through time. Borrowers move money from the future to the present to fund current projects and expenditures. Hedgers trade to reduce their exposure to risks. They perform do not take information motivated traders are active investment managers who try to identify overvalued investments. Instruments, securities are first sold in primary markets by the issuers. They then trade in secondary markets. People invest in pooled investment vehicles to benefit from the investment management services of their managers. Forward contracts allows buyers and sellers to arrange for future sales at predetermined prices. Future contracts are forward contracts guaranteed by clearinghouse. The guarantee ensures that strangers are willing to trade with each other, and that traders can offset their positions by trading with anybody. These features of futures contracts markets makes them highly attractive to hedgers and information motivated traders. Many financial intermediaries connect buyers and sellers in a given instrument, acting directly as brokers and exchanges, or indirectly as dealers and arbitrageurs. Financial intermediaries create instruments when they conduct arbitrage. Securities scrutinize assets, borrow to lend, manage investment funds, or pooled insurances contracts. These activities all transform cash flows and risks from one form to another. Their services allows buyers and sellers to connect with each other through investments that meet their specific needs. Financial markets work best when strangers can connect with each other without worrying about whether their counterparty is able and willing to honor their contracts. Clearinghouse variation margins, maintenance margins, and settlement guarantees made by credit-worthy brokers on behalf of their clients help manage credit risk and ultimately allow strangers to contract with each other. Information-motivated traders short sells when they expect the prices to will fall. Hedgers short sells to reduce the risk of long-term positions in a related contract or commodity. Margin loans allows people to buy more securities than their equity would otherwise permit them to buy. The larger positions expose them to more risk, so that gains and losses for a given amount of equity will be larger. The leverage ratio of value of a position divided by the value of equity supporting it. The returns of the equity in the position are equally to leverage ratio times the returns on the unleveraged positions. To protect against credit losses, brokers demand maintenance margin payments from their customers who have borrowed cash or securities. When adverse prices changes cause their customers' equity to drop below the maintenance margin ratio, brokers close positions for customers who do not satisfy these margin costs. Orders and instructions are to trade. They always specify instruments signed, buy or sell. The quantity They usually also provide several other instructions. Market orders tend to fill quickly, but often are inferior prices. Limits orders generally fill at better prices if they fill, but they may not fill. Traders choose order submissions strategies on the basis of how quickly they want to trade, the prices they are willing to accept, and the consequences of failing to trade. Stop instructions are attached to other orders to delay efforts to fill them until the stop condition is satisfied. Although stop orders are often used to stop losses, they are not always effective. Issuers sell their securities using underwritten public offerings, best efforts, public offerings, private placements, self-registration, dividend reinvestment programs, and right offerings. Investment banks have a conflict of interest when setting the initial offering price of an IPO. Well-functioning secondary markets are essential to raising capital in the primary markets because investors value the ability to sell their securities if they no longer want to hold them, or if they need to disinvest to raise cash. If they cannot trade the securities in the liquid market, they will not pay as much for them. Matching buyers and sellers in calls market makes it easy because the traders or their orders come together in the same time and place. Dealers provide liquidity in quota-driven markets. Public traders as well as dealers provide liquidity in order-driven markets. Order-driven markets arrange traders trades by ranking orders using precedence rules. The rules generally ensures that traders who provide the best prices display the most size and arrive early trade first. Continuous orders driven market price orders using the discriminatory pricing rules. Under this rules, standing limits orders determines trade prices. Both brokers help people trade unique instruments or positions for which finding a buyer or a seller is difficult. Transactions costs are lower in transparent markets than opaque markets because traders are more easily determine market value and more easily manage your trading in transparent markets. A well-functioning more functioning financial system allows people to trade instruments that best solve their wealth and risk management problems. With low transactional costs, complete the liquid market characterize a well-functioning financial system. Complete markets and are markets in which the instruments needed to solve investments and risk management problems are available to trade. Liquid markets are markets in which traders can trade when they want to trade at lower costs. A financial system is operating efficiently when the market is liquid. Liquid markets lower the cost of raising capital. Regulators generally seek to promote fair and orderly markets in which traders can trade at prices that accurately reflect fundamental values without incurring excessive transaction costs. Governments, agencies, and self-regulatory organizations of practitioners provide regulatory services that attempt to make markets safer and more efficient. Mandated financial disclosure programs for the issuers of publicly traded securities ensures that information necessary to estimate security values is available to financial analysts on a consistent basis. And FUS is reading 44. We're getting closer to that 60. We want to finish reading level 1, so we can move to level 2. Okay, we'll continue reading 45 security market indexes in our next reading. I hope my readings have been helpful. The show notes are in the description below. Go to Amazon. You guys can get the link right there. And I hope to see you guys next time. Without further ado, goodbye.